Hello again, everyone. This is Ken Weber, president of Weber Asset Management. Today is April 17th, 2025, Thursday. I'm here in Florida today. That's why the background might look a little bit differently. We happen to have a place on the water. The ocean is just one block that way. But Jack is ensconced in his usual office there on the shores of Lake Tahoe. Good weather out there, Jack?
It's just getting that way. I went on a 6-mile run this morning and yeah, it was pretty pleasant.
I went on a 3-mile drive this morning, but so it's kind of the same. It's kind of the same. Jack, we're going to get right to it. We have so much to talk about. This has been one of the crazier few months and certainly a few weeks in stock market history. The volatility has been, I don't know if it's off the charts, but it's certainly in many respects historic. It can come down to one word: tariffs. Traditionally, Congress sets tariffs. The Constitution says that Congress sets the tariff policy. Donald Trump has decided he can do it. I don't know if the courts are going to decide one way or the other, which probably would be okay with everyone if he had a clear plan going in. But the market volatility in many respects was simply because Donald Trump changed the tariff policy almost day by day, sometimes hour by hour. Literally, there were a couple of times when in the morning he said one thing, by the late afternoon he said something else. And the markets were reacting to the gyrations were due to the constant shifting of 10%, 30%. There are tariffs for everything, tariffs for a few things, no exemptions, lots of exemptions. It just became, there's no other way to say it. It was a mess. And it still is pretty unclear. And one thing the stock market likes, and one thing people who run big businesses especially like, is the ability to set goals and understand the path from here to, say, 3 or 5 years down the road. This is our environment. This is the basic political situation. This is the basic tax structure that we will face. Therefore, we can draw plans for either condensing our operations or expanding our operations, but the uncertainty is what is driving the volatility. So I have just done a longer introduction, Jack, than I normally do in these video calls, but that's the basic groundwork. That's the basic way the ground is right now. I'll turn it over to you for your explanation of what's going on.
Yeah, you can kind of liken tariffs to a big increase in corporate taxes because the amount of discount we've seen in the market is roughly comparable to, say, corporate taxes suddenly doubled. And in theory, it should be a one-time adjustment. But the current situation involves a high degree of uncertainty, and without analysts being able to forecast, and without some companies even being able to provide guidance, it means the traders are setting the prices, and that, I think has led to more PE ratio compression than you might normally have expected out of a situation like this. The U.S. economy is maybe 20 to 25% stuff, and the rest is services. So in theory, as long as the tariff and the trade war don't extend into services, this should be fairly easy to absorb. But I think the current situation is so uncertain that it has led to a lot of discounting.
That's interesting, Jack. All the discussion, and I'm a news junkie, a news nerd. I don't have a life. I read a lot, I watch a lot, listen to a lot, and almost all of it is focused on manufacturing. I mean, that's what Trump is talking about, bringing manufacturing back to America. Great idea, but a lot of it is very impractical. We're not going to, the Commerce Secretary talking about little screws going into the iPhones. Americans don't want to do that. And even if it did come here, it would be robots. But
actually, China is like rapidly automating their factories just because they don't expect to have a lot of labor in the future either. So,
but what I was going to say is that you're the first one to point out, which I'm embarrassed that I didn't think of right away as well. Services is what America more and more, our economy depends on services. Certainly you and I are involved in the financial service industry, and that is in many ways a worldwide enterprise. So
Mhm.
yeah, the world looks to America for many, many services, not just
Mhm.
things.
Yeah, service exports are our fastest growing export.
Is it really? I didn't know
Yeah,
that.
yeah, for the last 20 years, that's been the case.
Right, right.
Um,
So,
yeah, and
so
I think kind of the service thing is a double-edged sword because the more you become a economy revolving around services, it erodes your tax base, and we've seen that. Our large deficits and our large federal debt are kind of a, you know, indirect consequence of an economy that is less dependent on manufacturing and more dependent on services. And other mature economies have handled this with a value-added tax. Europe has had one for a long
right.
time. Japan enacted one fairly recently to deal with their debt. And I always assumed that the U.S. economy would move toward that when the time came. It's the tariff moves are, short-term kind of security and bringing back American jobs, but long-term they could produce more tax revenue, and there's a possibility that in conjunction with the DOGE work on making government more efficient, that you might get away with, not doing a value-added tax here, but it's really a tough call in the long run with more and more boomers on Social Security and Medicare. I mean, just to service those expenses alone may require a value-added tax given where we're going and where we're headed. So it's an interesting experiment to run. I don't think it's going to be that much of a negative impact in the long run. It's just a tough short-term transition, especially the way it's been done. I look to Powell because he seems to be the voice of reason.
Well, yeah, let
Yes.
me just say that Jerome Powell, for those of you who are not the news junkies, chairman of the Federal Reserve, let's just back up one more step. So Republicans control the House, control the Senate, control the White House, control the Supreme Court. Many people are saying the last little counterbalance to one side doing everything they want, basically one man, is the Federal Reserve, which is supposed to be independent.
Mm-hmm.
It is not supposed to be responsive to Democratic or Republican pressure.
Right.
They have one goal, which is to keep the economy stable, to keep interest rates as low as possible, and good employment numbers.
Mm-hmm. Yeah, it's a
Jerome
dual
Powell,
mandate.
as of today, is under pressure from Donald Trump, saying he wants him terminated as fast as possible. I hope that doesn't mean he's going to take some
Well,
action.
Trump nominated Powell, so it's
Well,
like,
Obama, right?
yeah.
That's right.
No, and
Obama put him
Powell's
on.
doing exactly what he was nominated to do. So,
Exactly. Obama put Powell on the Federal Reserve as a
mhm,
member, and then Trump elevated him to the chairmanship. But he
mhm.
is seen as by the markets, and you can give me a different opinion if you want. But as I see it, Jerome Powell is seen by the markets as a steadying hand, a mature
Yes,
person
I
who is
agree
looking
totally.
for the
Yeah.
long term for the best interests of the country. And no matter what side of the political divide you fall on, you want some counterbalance. And
Mhm.
Jerome Powell, it seems to be the last ounce of counterbalance that we have. So it's a little bit concerning that Trump is now, as of today, putting his thumb on that scale.
Well, yeah, but I
We'll have to
mean,
see how that plays out.
yeah, it may just be political theater. When it's time for Powell to be renominated, maybe Trump even nominates him again. Who knows?
It
It's
may
hard
be,
to
and
say.
he's
Yeah.
due May of next year, 26.
Oh, okay.
Yeah,
Yeah, it's not out of the question that Trump may elect to have him stay on board.
right, right.
He
We don't
changes
know.
his mind all the time. So,
We don't know. So,
um,
so the bottom line here, tariffs affecting the stock market, I think it's just kind of unknowable
yeah.
in terms of the next 3 months, for example.
Yeah, I think I went back and listened to Powell's testimony after the latest Fed meeting, and that was real interesting. He has a very kind of mild take on what tariffs mean in the way of slowing the economy and boosting inflation, and basically said that because of that, we'll have to hold steady for a while. And at that time, the market was figuring maybe we'll only get like 2 quarter point rate cuts this year. And then after the recent market volatility, the market more or less decided the Fed was going to cut 4 or 5 times. And so Powell came out yesterday to say, no,
Right.
that's not, how it's going to be here, because we do have this problem where unemployment and inflation may both go up,
Right.
and we may not be able to do much other than just kind of hold steady. So, and, that was interpreted different ways, but I think it just means, we're holding steady for now until we see how all this plays out. But
Right.
I don't think it's going to have a huge impact on inflation. I don't think it's going to have a huge impact on the economy. A lot of people are predicting recessions, but we've being a service-oriented economy, and with all the things that are happening on AI and all the investment that may be coming in as foreign car makers expand their factories and build all the cars here, I think we might see a negative quarter of GDP, just because a whole lot of inventory was brought in ahead of the tariffs, and that subtracts from GDP the way they do the calculation. But I don't anticipate that we're going to go into recession over this. And I don't, tariffs are also deflationary. They're not pure inflationary. They tend to cause some people to pull back on purchases, which is a deflationary event, not inflationary. So I don't think they're going to contribute as much to inflation. And the bond market, if you look at the 5-year,
Well, that's my next question. So
Yeah.
stock market, it's too difficult to predict. In other words, to our clients, we want to say we've carefully put you onto an appropriate risk level, or risk levels if you have several accounts with us. And we think there's no real choice here except to hold steady. The crystal ball is it's always cloudy, but it's extremely cloudy right now. Stay where you are. We should be fine. All of our long-term clients have been with us for 2, 3, some 4 major bear markets. And at the end of it, this is America. We come back.
Right. One of the reasons that we've done very little in terms of repositioning the stock side of the portfolios is that we already cut risk a lot last year when stock prices got really expensive. And so, I've kind of felt that, everything is behaving according to the risk scores. We're pretty balanced between growth and value in most portfolios. And it's really hard just to say what is going to recover first and lead the market once this is over with. So I've elected to do very little change on the stock side, focusing more on just kind of upgrading credit on the bond side. And
so let's talk about the bond market, because it started doing some somewhat unusual things during the height of the ups and downs. By the way, I was in Las Vegas at a financial conference as some of that was happening, and I was out of the loop for a little bit, and I didn't like it. And people were saying, "Could you believe what happened in the bond market?" And I hate being having somebody else tell me second or third hand what went on. So, Jack, explain what was happening with the bond market and what was unusual about the bond market activity during, for example, the stock downturns.
Yeah, I think you saw kind of a loss of liquidity that wasn't normally expected. I will say that the bond market tends to view the tariffs as more deflationary than the rest of than stock investors do, or even a lot of economists do. I've been watching the 5-year break-even and 10-year break-even rates, and at times, especially when the reciprocal tariffs went on, the bond market actually showed inflation declining, because they knew this was going to weigh heavily on oil prices, because it was going to slow all global trade. It was going to reduce global demand for oil. And so anytime you have oil taking a big hit, that implies that what's going on is deflationary, and the bond market saw it that way. And so I think a lot of people who say the bond market wasn't acting rationally are saying that because they expected the bond market to see tariffs,
well, some people
inflationary, when it doesn't necessarily do that.
Some people were saying foreign investors were, for example, pulling money out of U.S. Treasuries.
Yes. Japan in particular was pulling a large amount of money out.
That caused interest rates to rise here, meaning increasing our debt.
Yes. Yeah. And, it was really kind of a short-term issue, I think. As the bond market goes through a readjustment, it means that Americans are going to have to more or less fund their own debt. And, at a time where we're borrowing heavily on the federal side, that does move the needle a little bit. But we've kind of been on this path where we're going back to a normal shaped yield curve anyway. So I think this just kind of sped up the direction that everything was headed in the first place. And the bond market, I think, is being pretty rational about tariffs and what to expect, and the 5-year break-even rate and 10-year break-even rate projecting what inflation is going to be, which is right around 2.5%, even with the tariffs, I think is a rational view on the whole thing.
It's currently 2.5%. A month from now, we don't know. 3 months from now, we don't know.
But what goes on with the break-even rates is the inflation protected bond yields versus the non-inflation protected bond yields allow you to synthesize what bond investors believe inflation to be. And bond investors are saying, even with all these tariffs, inflation is going to be around that 2.5% mark next 5 to 10 years. So the bond market very much sees tariffs as kind of a one-time adjustment without a whole lot of impact on interest rates or inflation after that. So I think it's a rational view. Stock investors are, quite a bit more emotional about the situation, but
we always are.
Yeah. So maybe I to expand on the whole bond thing, we're probably at a transition time where stock returns the next 3 to 5 years are below historical, partly because the market was expensive going into all this. And even though PE ratios are largely normalized, we could still see some earnings impact as everything adjusts.
And we have to point out, we had 2 consecutive calendar years of 20+% gains.
Right.
In the S&P 500. So
there may not
we don't
be
have that
much,
and then have a third great year typically.
Right. So there may not be that much to lose.
Ways.
Right. The pendulum swings. There may not be that much to lose by going with a more conservative portfolio that includes bond exposure. In recent years, that meant a huge penalty in terms of total return. But I think the next 3 to 5 years, it cuts your risk. You may not have to give up that much in the way of total returns. So if anyone has felt nervous through all this or feels like the swings are just too wild to take or trouble sleeping at night, I mean, the growth and income approach really does probably make sense the next 3 to 5 years.
Right. Jack's talking to those of you who are fully invested. We can take you down the risk lever.
Right. Include some bonds in the portfolio. I know a lot of
many options.
Individual investors have really been opposed to bond exposure the last 10 years, but but the bonds are now at the point where the yields are rewarding you for the risks incurred and offering a nice premium over inflation. And I don't think it's a bad thing to have in your portfolio at this point.
Now, so the headline here is that Jack Bowers, unlike JP Morgan, is saying no recession. You heard it here first. And if it's not true, this will self-destruct.
Yeah, we may get a negative GDP quarter just because of all the inventory we brought in ahead of the tariffs. But that's just more a calculation. That's not reflective of what's really kind of happening in the economy. And, you look at, I was seeing on TV last night how people are like rushing to buy cars to beat the tariffs. It's like, I don't really believe the car prices are going to go up that much. I think just a lot more stuff's going to get made here. And if you're a foreign car maker, you don't want to cede market share to someone who's got more American content. If you're going to move all this stuff to the US anyway, you're incented heavily to absorb the tariffs until you have your factories up and running in the US. So I think people will be surprised that at least on major items, prices don't go up as much as they're expecting.
Okay. I just bought a new car. We'll talk after this. So we talk stocks, we talk bonds. Several of our clients have asked us international stocks. They've asked about that. International stocks in general have lagged the American stock markets for the last several years. And the question is, okay, Weber, is this time to jump in or put a few toes into the international water of stocks? So there's the question, Jack. What do you think?
I kind of feel like, the American firms do business overseas. And I think the S&P 500 has already 30% revenue exposure. And
that's what I always point out. The S&P used to be purely American, the Dow years ago. And now you know, what's Apple? I mean, all these big companies get so much revenue from abroad, you can't really call it truly a pure American company anymore.
Mhm. So in terms of exposure to global growth, you don't really need foreign stocks. Now, the argument for them now is they're a lot cheaper than US stocks. And that may be true, but I'm not sure European markets don't have much growth exposure, for example. They're largely kind of value stocks. If you compare European value stocks to American value stocks, there is a slight discount for the price incurred, but at the same time, the European economies don't have the productivity growth that we have right now, partly because they're not adopting AI as aggressively as American companies are. So I guess right now I'd rather just be in American value stocks than in European stocks, for example. There are some interesting things going on in Japan, and some Fidelity fund managers have Japanese exposure.
I was just going to say that for our clients, many of our portfolios that we hold for you, there are international stocks if the manager sees a bargain in Japan or Germany or somewhere.
Yeah. So, and we're also at a time where the dollar is making an adjustment downward as well. That also speaks in favor of foreign stocks, but that might be a temporary thing. The dollar is just trying to find its new equilibrium point based on the new trade realities, and once it does, that trend is going to stabilize. So I think there could be a tendency where, well, the foreign stocks look good, let's go do that, and then once you get there, they don't really, the U.S. stocks start recovering. So I'm not convinced that's like the best way to go. But all Fidelity funds, including the ones that we hold in the portfolios, they have some degree of foreign stock exposure
Absolutely.
already, and I kind of feel more comfortable letting the domestic stock fund managers decide which European or Japanese stocks are more attractive than the American stocks they hold, and let them make that trade-off. If they think foreign stocks are more attractive, they'll step up their foreign percentage.
Jack and I don't agree on everything. We agree on that completely. Jack, we've run out of time. Thank you so much for stepping inside after I know you're enjoying the weather, and you have Jack has a wonderful house on Lake Tahoe, and I'm jealous, but I have nice things here in Boca Raton for a few weeks a year. So as usual, if you have questions about anything you've heard here today, or you think you want to evaluate where you are on the risk ladder, we're a phone call or an email away. And it was great chatting with all of you, and hope you got something out of this. Thank you, Jack.
Yep.
Thank you, Jack. Good talking to you. Bye, everybody.